Good evening, Doc Severson here for the TheoNight Report for Tuesday, May 2nd. Okay, the big news after market here, after hours, is that Apple just reported, and they beat the bottom line number, but I guess the number of phones that they sold was a little soft, and everything else depends on them dominating the phone market. So Apple is down a couple of bucks in the after hours trading, so this is not huge damage. But this is after, of course, we've seen just explosive moves, notably yesterday, in most of the tech stocks. Now, today was just a very drifty day here. Not much at all happened, in very low volume for that. So we can see the S&P 500 futures just have gone nowhere over the last 2 days. And zooming out to the larger charts, again, the whole hypothesis here is that if the price is unable to punch through the 2400 level and create a new higher high, then this is going to be a big bull trap, and this is going to turn into a lower high and roll over. So this is a very important point here in the S&P. Now, if that did happen, that's not the end of the world. In fact, I think it would actually be a good thing for this to fade at this point, because that would bring that 2300 level right into view. And I think that would stoke up a lot of negativity. And what you'd see is the charts would be recharging very, very quickly from here. First of all, the weekly, and then ultimately within a month or so here, the monthly chart would also be able to recharge. Now, again, I pointed this out many, many times, is that when we have this level of linearity and this level of exhaustion, this is relatively rare. Over the past 20 years, you can see that we've only had this level 1, 2, 3, 4, 5. This is the 6th time over the last 20 years. This level of linearity to a trend like this, and specifically to an uptrend, is particularly notable for that. So all of this price action that we've had over the last 2 months, where the price has essentially gone nowhere for 2 months, has been very constructive. It's done exactly because this is a very rare signal that we had here at the end of February, where we had every single chart time frame that I can deal with was in exhaustion. And so that was actually a good signal here to go into the next phase, which is that from range expansion goes to range contraction. So now the opposite is happening. We've actually started to see the weekly and the daily chart recharge very quickly, but here's the question: can these things continue to trend to the upside with a still exhausted monthly chart? And that is what we don't know yet. Typically, it does need a little bit more time than this, than 1 month of red candle, for this thing to start trending again. Now, when we gave this same level of scrutiny to the NQ has been much, much stronger lately. So it too did go through a consolidation period here at the end of February and into the end of March and into early April, but it has absolutely exploded higher from there and is now in danger of going into the next consolidation zone, if not pulling back outright. So this is something to watch, and we don't know whether something like the Apple miss tonight could start a chain reaction to the downside. Remember, guys, nobody has seen any real selling for a year and a half. It's been not since the first couple of months of 2016 that we've seen real red candles in a waterfall decline. In fact, if we take this to the next step, which is just to look at Amazon and Apple and Microsoft and Google and Facebook and Netflix, which are really the guys that are driving this market, we can also see exhaustion signals around here. And then if we go back and look at these, and we look at least the weekly signals. So let's look at least the weekly signals that have caused exhaustion in the past below a 38.2 level. Okay, so we can see that they're fairly consistent, right around mid-30s or so. We'll typically get a reaction of some type. Again, I'm not looking for a sell-off. I'm just looking for corrective price action, which is going to raise the volatility and give us more to work with. Okay, so each one of these where we saw this chart go into this level of exhaustion, which it's very, very close to doing right now, created some type of serious reaction in the past, over the past few years. Now, every moment in the market is unique, as Mark Douglas is fond of saying, so I'm not looking in the back and saying, well, this has got to happen. All we're doing is looking at this from a probability perspective. Now, something else to keep in mind, and I've been bringing this up quite a bit lately, is this neat little feature here, the S&P 500 above the 50-day moving average, a percentage of the S&P 500 above the moving average. And anytime that I see this going on, where I see a divergence, where I see prices basically heading higher up to all-time highs, or at least holding steady up there, and I see a declining percentage of stocks in the S&P above their 50-day moving average, which generally infers a short-term uptrend, right? So this is not necessarily a good thing, and this has led to some interesting reactions in the past when we get this divergence showing up, right? So we're about 3 weeks into earnings season now, and most of the fun is out of the way. Now we can start to look to economic reports again for our source of market movement. All right, so tomorrow morning we have the ADP report. The last time that this was reported early April, this did cause a big move, which a couple of days later for the actual Fed report, this one was a real bomb and the market doesn't really do much of anything. So this is the same old game that we're playing right now. But will bad news, and we had bad news last time. Bad news didn't really care. Nobody cared about bad news in the past. Will bad news, if we don't hit this one out of the park on Friday, will this cause a similar reaction, or will it actually start to fade back down, considering that everything is a little soft right now? Okay, some other things to watch out for, some of the ISMs, and of course, we've almost forgotten about the fact that the Fed is meeting tomorrow. Isn't that a great thing? As recently as a year ago, the whole market would just completely hold their breath weeks in advance of the Fed meeting. It basically would grind to a halt and look for that wisp of smoke coming out of the chimney in the square to let us know that the Fed had indeed met together and they had consented upon an opinion. Now, we've definitely seen a shift in how the Fed has been operating lately, where the Fed has been actually very, very transparent. None of this mumbo-jumbo, none of this Fed speak sort of stuff. The Fed's been very transparent about what they intend to do. And in fact, that's almost a little confusing. People aren't used to that. But basically, when they actually do an announcement, it's almost exactly per the script. You know, you can liken it to Janet Yellen stepping up to that first tee and striping a driver 300 yards right down the middle of the fairway every single time. So she's getting to be very, very consistent. People are understanding her and reading her. And to some degree, I think she's making the Fed a little bit of a less of a political entity right now. Now, don't get me wrong. I am still not a big fan of the Fed. I don't believe that the Fed should have that much power. I believe that power should be kept with free markets. But we're getting a lot less drama out of these things here, and that is actually a very, very good thing going forward. So, yeah, maybe we're going to start to see a very gradual hike cycle in here, and I think the market can handle that very well. So, again, we've got a number of announcements coming up over the next 3 days, so it should be interesting to watch some of these, like factory orders, and of course, employment situation. And this makes me a little nervous when we have this much Fed speak scheduled on a Friday and even a Saturday here. A lot of Fed speak after a jobs report. Do they know something already about that jobs report, and are they proactively out there, you know, to make a preemptive strike before the market can get a grip on what could be a bad report that's out there? So net over the next 3 days, there's plenty of risk out there. There's a lot of landmines that we have to tread carefully over. Watch that lower high on the S&P. If it truly turns into a lower high in the S&P, that will be a weekly lower high, and we're going to quickly drive lower from there because it's going to catch a lot of people off balance. That is it for today's report. Thanks for listening, folks. We'll see you tomorrow.